All right, let's get started.
Round 2 of
Round
charts
2.
and chill.
What is up, everybody? Welcome back to another Q&A. So, if you guys got any questions, feel free to drop it in the chat. Happy holidays, everyone.
Happy Thanksgiving. Oh, that was yesterday, I guess.
Yeah, American Thanksgiving yesterday. So, happy Thanksgiving for the most part.
Let's see. Did I end up doing anything? Did
Nope.
not end up doing anything.
Markets did absolutely nothing today. But we'll see if we get a lively Q&A today.
Hello, Sue. Hello, hello.
Hello, Sue. Hello, Yuck. Hello, DGTO. Are you guys able to hear us fine? Maybe a little echoey. We're planning to add some like furniture and stuff. It's just newly renovated, so it's a little echoey. But we will fix that soon. Maybe some rugs. Maybe some a sofa.
What's up,
Hello,
Ian?
hello.
What's up, Chris?
What's up?
What's up? Okay.
So again, if you guys have any questions at all, feel free to type it down in the chat, and then we'll kind of get into it.
Pinatas. What's that mean? What do you mean by pinatas?
Black Friday sale on the membership. It's gonna be 4 weeks free trial.
Let's wait a bit. Wait a bit for some people.
Sound dampeners.
That would help.
Yep.
It'd just be, yeah. Is it very echoey? It should
It's
be.
probably really echoey right now.
Give it a sec.
Literally, what it sounds like right now is probably what we hear, because it's picking up everything.
Oh, okay.
Yeah.
Oh, so you just made it like even more open than last time.
Yeah, exactly. So then there's no like weird filter over it. What's up, Dylan? I have a question on Tuesday price action. Why don't we consider average true range since we had a 200 plus point move, but all that reversed? At least consider trailing. ATR is average true range, right? Is that what you're referring to? Just making sure. Tuesday PA. Let's take a look.
Lit up.
Is it the short we took and then it kind of like retraced at?
Yeah.
Yeah, okay.
I think so. Yes, some way to take advantage of the move.
Save and reload. I just gotta reload my chart here. Give me 1 sec. So this is the chart. Tuesday price action. If it wants to load. Okay, there we go. So the reason why there was no way for me to really capitalize on this move is, yes, at one point we're up like 3R, 4R on our trade. However, the reason why I didn't trail is because the intermediate term time frame, right? We had a previous day high SMT. And from the previous day high SMT, we also had the London high SMT. So our higher time frame, the intermediate term time frame, and also the lower time frame all were aligned for bearishness. So in order for me to have something to do in terms of a management plan, is if we have the intermediate term time, at least the intermediate term time frame, telling us that the narrative is somewhat invalidated. Because if we look at the daily chart, at this point in time we were just at a premium of the range, right? So I just replay this real quick. Right, so this was the range right here. Right, at a premium within the 90-minute fair value gap over here, looking for continued lower prices for that continuation, right? So internal looking for external range liquidity. And so because the higher time frame and the intermediate term time frame is aligned, especially this being previous day high, we were looking for previous day low as the target. And I know in our pre-market we talked about how this could potentially be a retracement level for if we were to continue bullish, but the only reason why this was not a valid moment to manage our trade is because we need to see, again, at least the intermediate term time frame narrative. So if there was like a previous day low SMT, then I would have been able to, but the only thing we had was a London low SMT. So if we put that into perspective, that would be a lower time frame SMT, right? So if we were to just manage our trade purely off of the lower time frame SMT, if you apply that same rule, because again, it's very important that we stay consistent in the way we manage a trade, not just really changing it around based on specific scenarios, but rather having a set way in our plan so that long term we know exactly what we're doing in a consistent manner. So in this case, it's just framework wise, it didn't tell me to manage my trade, it didn't tell me to break even, it didn't tell me to get out early or anything. It was just a lower time from SMT opposing me. So in terms of the plan, like there's just nothing I could really do there. So yes, in hindsight, like even Elijah and I discussed it, we were like we could have taken profit. Like at one point we were like 3-4 R in profit, we should have closed early. But once you get into that kind of thinking, that's where you start to spiral into constant refinement of your plan without proper testing. So if this keeps happening over the span of maybe the next 15 to 20 trades, then yes, we'll probably make a refinement to our plan. But this is a very rare occurrence where we don't get any trailing opportunity, we don't get any opposing narrative, nothing. It just continues trading against us. And that's okay. Sometimes that just happens, and that's just a valid loss on the model. But again, after like 15, 20 trades, if this keeps happening, then that's something we could potentially refine where it's like, oh, maybe when we hit 3R in profit, we just move to break even automatically. But as of right now, there's just no management rule telling me if it stabs down lower, there's no intermediate or higher time frame opposing narrative. It's just a lower time frame narrative that was opposing. So there's nothing for me to do. So that's basically the logic behind that.
Yeah.
But again, it just comes down to like, what is in your plan, right? You got to ask yourself, at the end of the day, it's like whenever we're trading and we feel some sort of way like, oh, the market did this, we just ask ourselves, is it part of the plan? And we just refer back to the plan, go through it and be like, it's not part of our plan to manage a trade right now. So we're just simply going to leave the trade the way it is. You want to answer this next one?
Yeah. Hi, Ethan, Elijah, and everyone. When we formed bullish SMT at previous month low, would that have been invalidated at the bearish SMT at previous month high, especially as the monthly time frame, we are still showing the bullish market structure. Let me take a look at that. Give me a second.
Do you want me to answer actually?
Yeah, you can answer.
Okay.
I need to take a second to pull it up anyways.
Okay. So if we take a look at the chart, the reason why I put more weight on the previous month high SMT rather than the previous month low is because if we look at from a swing trading or a position trading perspective, right? We have this previous month high SMT, and this is valid. Why? Because if we go to the monthly chart, we are at a point of external range liquidity, right? We've been at a point of external range liquidity for quite some time. So what confirms that narrative that I'm looking for external to internal range liquidity? And that would be a lower time frame SMT of either 1 or 2 time frames. So in this case, we had a daily time frame SMT, which was with previous month high, right? And so that confirms the narrative of essentially I'm looking for external range liquidity on the highs here for internal range liquidity from that point on. So in terms of the model, I'm doing the exact same thing. I'm just applying it on a higher time frame. So yes, this previous month low SMT could be valid, and so far it's looking like it because of the change state delivery on all three assets. But at the same time, you have to pay attention to what the big picture's narrative is as well, right? So it's very important to keep that in mind.
Yeah.
So, yeah.
In short, yes. That's
yeah, in short, yeah.
That's.
But that's a full explanation of why I was looking for lower prices, pretty much.
Yeah.
And also, if you look at daily structure, right? Still looking for lower lows, lower highs, lower lows, right? And so from there, that's why I was looking for continued lower prices. Just simply because of the monthly time frame narrative, looking from external to internal range liquidity. So let me just delete some of these lines.
On ES 4 hour, or Dylan asks, on ES 4 hour, would you guys consider a trend shift at the lows with that reversal, especially since it was off weekly protected low? So I think it's the same S&P talking about. ES 4 hour, would you guys consider a trend shift at the lows with that reversal, especially since it was weekly protected low? So let's hop in the 4 hour. Yeah, it's here. Right?
So he's looking at something like this on the weekly chart. I can just turn it. So this is what you're looking at on the weekly chart. This is protected low. Exact same analysis I just gave for the other question. This low right here is previous month low. So you could, like, if you drop down to the 4 hour, or I'm going to use the 6 hour, you could consider this right here to be a trend change or a change in character or a market structure shift. But one thing to keep in mind is that this high right here is not the high that created this break of structure. This high is the high that created the break of structure. So to consider it a valid market structure shift, in my opinion, is if we get a closure above this high, which we now have, right? So that's more of what you would be looking for in terms of market structure. And again, the reason I do it this way is because it's the most confirmation you can possibly get is the high that displaced lower, creating break of structure, right? This is the protected high. So until price closes above that, for me, that is the trend change, essentially. But we can identify earlier trend changes off of, let's say, higher time from SMT, higher time from key levels, stuff like that. So for those that are bullish, like that are in the chat right now and are bullish because of this previous month low SMT, like that is completely valid. Because even if we weren't using SMT, if you look at this, this looks like a liquidity purge of previous month low, which would, you know, start a market maker buy model. So if you're bullish because of this reason, it's completely valid. It's just in terms of my model, the reason why I wasn't paying too much attention to that yet is because one, it wasn't confirmed on the daily chart yet, and then two is because the monthly narrative, right? So again, there's always going to be, like, there's no right or wrong in the market. It's just about what kind of confluences are you using, I would say. So what does your model say?
Yeah.
Does that answer your question?
Sweet. So what deals are going on?
The TradingView Black Friday deal.
Yeah, anyone get the deal? I still need to get the deal. Let's see.
I also need to get it, but I'll get it after the stream.
Oh, okay, people are just getting premium. We're running on right now. Alright, cool. I see what you're saying, thank you. No problem, Dylan.
Okay.
Yeah, just keeping it simple. and just keep it simple, repeatable, and if there's downtime, then we have risk management.
Sorry, came in late. When would you consider long trades? I think right now, like in terms of like trading, like today I'm not trading because it's a half day and it's also the holidays. But for a long, essentially what I'm looking at right now is we do have this market structure shift on the daily chart, which is important, and then this is my current dealing range. So what I would like to see is, honestly, I wanted to see this today, but again, it's a half day, it's a holiday. So I do want to see a retracement since we took out this buy side liquidity. So this is going to be considered your external range liquidity now. Top left. So that's your external range liquidity. So we could be looking for really any of these fair value gaps right now. So if we trade into one of these gaps as internal range liquidity, then I would continue looking for longs into external range liquidity. So any of these fair value gaps. So if price trades in, right, let's say on Monday or Tuesday, get an SMT on the highs, previous day high SMT, for example, then I'd look for something like this, or even like this. And what tells me to change my narrative is, again, SMT on the low, SMT on the highs, right? So I just continue to follow the intermediate term time frame SMTs in alignment of my higher time frame market structure within the context of external internal range liquidity or internal external range liquidity. And that's pretty much what I'm looking for. So I am interested in longs now, because especially like this previous month low SMT is like pretty much confirmed at this point, looking for all-time highs again. Trump also tweeted out that he's going to keep stocks at all-time high, which is a great indicator. So
okay.
So
yeah, I guess that answers your question as well, Sue. So that we, like as Ethan mentioned earlier, the reason why this week it was like a lot of patience and waiting is just we didn't have that closure, right? So now we have that market structure shift on all indices, and now that we have that, we can look bullish, but we could also just look for like a slight retracement before continuing higher, right? And that will be based off of time-based SMTs. Dylan says, that's a big problem for me lately, overanalyzing. Yeah, when you do too much, it's hard for it to be repeatable and also trackable, right? Have you guys ever back tested trailing the stop on one time frame lower? So I'm assuming one time frame lower than the one we enter on. Example, enter on 15. Oh yeah, enter on 15 and trail with 5-minute market structure. So I personally have not. Have you?
I have back tested that.
Okay.
And through my back testing, it stops you out way too much. So it's like if we're aiming for, let's say you have like a, I want to say it's like it's a good way to protect yourself, but when you're doing something like that, it's kind of like the saying is like now you're trading to not lose rather than you're trading to win. You know what I mean?
Yeah.
So that's kind of the thinking that goes into that kind of back testing, in my opinion. If it was really effective, I think it's fine. But through my back testing, the reason behind, so you have to ask like, what's the reason behind your question? The reason behind my question when I asked that question, right, to back test it, it was because I wanted to avoid more losses, right? Let's say on, I don't know, for example, on Tuesday, if I trailed the 1 minute chart, I would have for sure made profit and I'd get out, right? But the problem with that is that over a long period of time, it actually diminishes returns because I'm targeting something on, let's say, the 90-minute chart or even the 6-hour chart, right? I'm targeting an intermediate term time frame target, and I'm trying to trail on a significantly lower time frame. When something like that happens, is you tend to get stopped out a lot. There's a lot of noise compared to what you're actually trying to trade, which is why I always suggest if you're going to use a lower time frame in relation to a lower time frame or in relation to a intermediate term time frame or a higher time frame, always only drop down 1 or 2 time frames. Is from there, like back testing like 3 time frames below, it's never worked for me. It's kind of like, let's say you're in a daily fair value gap and you're looking for a 1 minute market structure shift to react from that daily fair value gap. How many times do you think you're going to get that market structure shift before it's actually true, right? So just make sure that your perspectives are aligned and understand that majority of your trading plan comes from very similar foundational logic. So our logic is again, time frame alignment, market structure, and SMT, right? So we have to make sure all of our rules align with that logic as well. So it builds a proper framework, right? And again, it just comes down to consistency, right? Like, what can we apply right now that is long-term consistent? I just want to answer Dylan's question real quick, and about like keeping it simple. Like, to be honest, just use market structure. It's just the easiest thing to keep things simple. Market structure has always been there since the beginning of time, and it's always going to be there moving forward. It's never going to change. You're always going to have higher highs, higher lows, lower highs, right? You're always going to have consolidations. But if you just keep market structure in mind, it'll give you a general direction, and then you can incorporate different concepts with market structure, and for the most part that will keep you aligned with the market. So that's a very great way to keep it simple, and that's what I do.
Yeah, I guess I can answer Mike's question. I'm assuming he's referring to when we were talking about looking for a little bit of retracement into internal range liquidity and then back continuing higher, following the bullish narrative. So here we're just looking for internal range liquidity. So that's why, and what would be confirming it would be time-based SMT. It'd be nice if it digs into discount and then we go higher, but that doesn't necessarily have to be the case. And what really confirms that and tells us otherwise is intermediate time frame SMTs, or just like any sort of setup in between that can, within the gap, that can tell us higher. So you can show it on the chart as well.
Yeah, so I'll show you right now. What I mean is, so let's say this is our higher time frame, right? The daily chart is where I typically start with the higher time frame. So I'm just going to visibility interval below. So in order to confirm whether we're going from external back into internal range liquidity, what I would need to see on the highs, and this goes with any time frame, it doesn't have to be the daily time frame. It's higher time frame, intermediate term time frame, lower time frame, right? So right now I'm using the daily time frame as my higher time frame. Okay, so keep that in mind. So if the daily chart is my higher time frame, what would be my intermediate term time frame? Well, your intermediate term time frame is always going to be one time frame or two time frames below the higher time frame. So in this case, the daily chart, right? So below that is 6 hour or 90-minute chart for me. And so what would I look for from there in terms of SMT? It's either a previous week high SMT or a previous day high SMT, because we're looking for external to internal in a bearish manner, right? We're looking for a bearish retracement essentially. So dropping down to the intermediate term time frame, I'm just going to go on the 90-minute chart so it's a little easier to draw out.
You can also use the 4 hour or 1 hour.
Yeah, you can use 4. Like 6 hour is just my replacement for 4 hour. 90-minute chart is just replacement for 1 hour. Yeah. So what I would want to see is essentially, like, let's say we're on the 90-minute chart. And if that's the case, then I'm looking for a previous day high SMT. So let's say going into Monday, we have consolidation today, and then we get an SMT on the highs, where one market creates an SMT, the other one fails to create a new swing point, so that's your SMT on the highs. So as long as I have this SMT with previous day high, this is pretty much the intermediate term time frame telling me that, hey, your higher time frame narrative is now being confirmed. It's time to look for opportunities in the counter trend direction, because we're looking for external back into internal range liquidity, right? So once I get a change state delivery on the intermediate term time frame confirming the SMT, that's where that pretty much validates my idea to look for that retracement. And so the exact same thing from here on out, what I look for on the lower time frame, like if we were to drop down, so what is the lower time frame relative to the intermediate time frame? Again, it's just 1 or 2 time frames down. So if I'm using the 90-minute chart, then that means I have to go to the 15-minute or 5-minute. If I'm using the 6-hour chart as my intermediate term time frame, then that means I have to go down to the 90-minute chart or the 15-minute chart, okay? So that's the way to go about it. And so from there, once that intermediate term time frame narrative is confirmed, I'm doing the exact same thing. So let's just say we had a market structure shift here to make it even simpler. I would draw out another dealing range right here, right? Now that my intermediate term time frame is aligned with my higher time frame, looking for external back into internal range liquidity, right? Because we have this previous day high SMT. So on a lower time frame, I'm not actually going to drop down to a lower time frame. Just zoom in on this. On a lower time frame, it's the same thing. So let's say you have a fair value gap resting at premium right here, okay? And so we want to wait for price to trade back into this internal range liquidity. And on a lower time frame, again, all we're doing is waiting for SMT at a premium of this range, right? So now the higher time frame is bearish, right? Because you have the narrative external to internal. The intermediate term time frame is bearish because you have this market structure shift, and you have the SMT, you have the change state delivery, whatever you're looking for. I would stick with market structure to keep it simple. And let's say we have a lower time frame SMT right here, exact same thing, get a change state delivery or market structure shift, whatever you want to use. And then that's my trade entry. So you can see how I'm aligning all of my time frames together to build a narrative, and then I'm going to target either the intermediate term external range liquidity, or I'm just going to target the higher time frame, right? Whatever makes sense. In this case, like the scenario that I've drawn out for you guys, I would just target the daily fair value gap because it's not that far off from the intermediate term external range liquidity. But this is pretty much the same concept, right? If we take this out, then I'm looking for retracement and continue. External range liquidity back to internal range liquidity back to external, just on the intermediate term time frame. So I learned this from MXM Trader, so I'm just gonna quote it as well. It's like the higher time frame is telling me why I'm looking for a target. So why is price bearish in this case? Like, why am I looking for a bearish bias? It's because we're going from external to internal, right? And the intermediate term time frame tells me how are we going to get there. And so in this case, we can be like, how is it going to get there? We have a market structure shift here. We should see a retracement back into internal, then lower into external, and then back retracement into internal, and then again another external range liquidity purge into that higher time frame key level, right? So the higher time frame is giving me direction, intermediate term time frames telling me when is a good idea to actually get in the market in alignment of that, and then lower time frames just simply for execution and management. So whenever you see those execution videos online, it's mostly because the homework's already done for you. They're just simply showing you the execution, the trade, right?
They don't show you that part.
Yeah, exactly. They don't show you the top down, the homework they did, the fundamentals, all of that. They don't really show you that. They just show you, oh, I made this much money today. But what was the work that was put into that trade that actually made it successful? So yeah, honestly, like trading is like, it might seem like you're making like $5,000 in 3 minutes, but the reality is like you spent a bunch of time planning it, right?
Yeah.
So.
And then Luke says, thank you. Such a great answer. I started to backtest it the other day, noticing the premature exits,
Referring to the dropping down to a lower time frame.
and trailing. Yeah, the way we've been trailing, honestly,
Has made it so I don't think we've almost ever prematurely gone stopped out or exited unless it's like discretionary.
Yeah.
so it's been a game changer for us as well. Like honestly, it's like it's either it's the idea it gets invalidated completely, or like you get just trailed out or something like that.
Yeah, I
It's
want to
not
say like
premature.
95% of the time, because we are trailing market structure in alignment of our narrative and framework, when it does stop us out, that is typically when market is just straight up going the other direction. And again, I say 95% of the time because every time I'm stopped out, let's say whether that I'm profit or I'm like just stopped at my trailing stop loss, or I'm stopped at the stop loss, original stop loss, market just goes the other direction completely. So that's a very key thing, is when you're exiting, you know you have a good exit because the market either starts stalling or it starts reversing on you. So that's how you know you have a good exit. Or that's how I think about it, at least.
Jaw 2010 says, can you give me an outlook on Euro USD, XAU USD, and Nifty 50?
I'm going to have to come back to that, but I'm going to answer Mikey's question first. On your answer to Dylan, when you were saying just use the market structure, I assume you meant the daily. Yes. And then Dylan asked, let's say we drop... Oh, when I said use the market structure, I mean use it in alignment of all time frames. So it's... Okay, I can draw it out for you. Higher time frame, let's say you're trading from internal to external, right? If we were to zoom in on this right here, when price was trading into this internal range liquidity, it would look like this on a intermediate term time frame. something like this. Okay, you have a market structure shift right here, right? That's aligning your time frames, right? So not necessarily on the daily time frame, not on the higher time frame.
Screen.
Oh, whoops, my bad.
Yes,
So
yes.
not necessarily, sorry. So this is the higher time frame right here. So say this is your daily chart in the example I just showed you guys, but again, this can be whatever higher time frame you want, right? And then once you trade into that key level on the intermediate term time frame, this is what you're gonna see. You're gonna see a market structure shift, right? To align yourself that yes, you're looking from internal to external range liquidity. But what we're doing is we're taking this one step further. Instead of just using the higher time frame, intermediate time frame, we are taking it one step further, zooming in on this and looking at it on a lower time frame and using that as our entry. So where did it do that? I mean, something like this. Boom. Maybe a little liquidity sweep, continue higher. You know, something like that, for example. This is going to be the lower time frame. But what we're looking for is market structure shift has occurred on the intermediate term time frame here. And we're looking for either another break of structure or we're looking for another market structure shift right here. And once all three assets are aligned, this is a model in itself. I will say that much. This is a model in itself. I teach this to my private students that are struggling to use SMT. This is the absolute foundation of my model. You can do this without SMT as long as you have three assets, or not three assets, as long as you have one asset, three time frames are aligned in terms of market structure. This is already going to give you, you're going to hit bias more often than not already with this. So it just keeps it very simple.
Yeah.
But to answer the question about when we trade into this fair value gap, what would we want to see? Let me just undo, so let me get all the way back here. What would we want to see in order to see one of these daily fair value gaps respected? It's the same thing on an intermediate term time frame basis. We just want to see a opposing, right, a supporting bullish SMT on the intermediate term time frame that validates this fair value gap or whatever key level you have on a higher time frame that validates that is going to be the play you're looking for. So here, let's say we have an SMT on the low. Great. Then you're going to look for higher prices from internal to external range liquidity on the higher time frame, right? But in what case would you look for price to continue dropping is if you just simply don't have any SMTs. There's no previous week low SMT in our case because we're using the daily chart. There's no previous day low SMT, right? If there's no SMT, this was never confirmed. It's just I just continue looking for lower prices into the next fair value gap. So let's say price gets into this fair value. What am I looking for? Nothing has changed. I'm looking for either a intermediate term time frame SMT on one time frame or two time frames below the higher time frame, right? So here, let's say we have a SMT, validates my idea, change state delivery, boom. Now I'm gonna look for internal back to external range liquidity on the higher time frame. Again, same thing. What happens if we don't have SMT in this gap? Just looking for the same thing. We're just continue looking for lower prices, right? Boom. Right, and then it taps into this final key area that we're looking for. What happens if we don't have SMT over here as well? Well, at that point, you're really just looking for continued lower prices into the opposing side of the external range liquidity. And the reason why I say that is because, and this is how like sometimes Elijah and I will call that even though we don't have an SMT on the highs on the higher time frame, we can still look for the opposing external range liquidity because none of these internal range liquidity or key areas are being respected on our higher time frame. And there's no confirmation on the lower time frame either. So we're just going to continue looking for lower prices. So basically, until we have a bullish intermediate term time frame SMT, we are going to continue looking for the push into the range.
You know, basically ERL, IRL over and over again, and using SMTs to confirm, and also invalidation of SMTs.
Yeah.
Right. What did you want to go back to chat later?
Yeah.
What average win ratio? So we float around, I'd say like 40 to 50%.
Yeah, I think
we float around 40 to 50.
Year to date, we've been floating around like 45 to 50% win rate. Is that what he asked?
Yeah. Or Gasper asked.
Gasper.
And then Mike asked, this is a very good question. And YM, I guess it's a question.
Oh, okay.
Does like YM have equal value S&Ts as the others?
Yes.
Yes, pretty much yes.
YM's actually the one that usually creates the SMT. But yes, it is equal value. All three assets are equal value to me. ES, NQ, YM.
Yeah.
Okay, so that answers those questions. Can you give me an outlook of Euro USD and gold? And I don't know what Nifty 50 is, but I gotta look at it.
I love YM. Yes, Hike is Golden Nuggets. STM is a big YM fan. But YM like it may look like YM fakes out a lot, but that's why we also have filters, right? Like change in state delivery. If we have the S&P with change in state delivery, especially on all three markets as well, and the markets are moving in tandem, then there is good probability that it will continue the direction, and it's also been confirmed. So since we're not seeing strong reactions at ERL and ES and Y, actually there's one question at a time.
Just outlook on Euro USD, I'd probably be bullish as of right now because it looks like there is quite a few SMTs on the low. So bullish on EU, bearish on DXY, gold. And I'm just gonna give the outlook. It's fine.
Okay.
Yeah.
Okay.
Gold, I don't even trade gold, but I think it's just bullish.
Gold's just gold.
Gold is honestly, I can't even give you like an accurate analysis on gold because I feel like gold moves different. I will say that, and it's hard for me to grasp it. I don't know. It's just for me. But if I were to say one direction, I would be. If I were to lean one direction, I would probably lean. As much as I want to lean bearish on it because of the SMT at the high, I think order flow is just extremely bullish on it.
Yeah.
So I think gold has potential to continue higher.
Not financial advice.
Yeah, actually, no. I would just say gold is bullish. Gold is bullish. I'm just looking at very simple analysis, market structure, and market maker models. I would say gold is bullish. EU, I'd like to see it continue bullish as well because of the SMTs on the lows. And then I gotta search up Nifty 50. Nifty 50.
Dylan says you guys would kill it on gold. You guys would capitalize on the momentum. I mean, I've just always just studied and forward tested future indexes, and it works. I just don't want to change too much. I've heard mixed reviews on gold. Some people say it's like too volatile, too dangerous. Some people say they're like banking crazy. So I don't know. Like I'd rather just stay out of that. But I'm pretty sure Ethan's traded gold before, and he's done decently well.
I have traded gold before, but swing trading.
Yeah.
So for Nifty 50, I want to say I'm bullish overall. And if you go on your monthly chart, actually, I'll just show you guys.
Yeah.
Easiest way. Okay, so when it comes to Nifty 50, I would say that overall I'm bullish because structure is just extremely bullish. However, one thing to take note of is that your previous year high has just been hit. So typically whenever you hit a major liquidity pool like this, you can drop down to a lower time frame and potentially look for some sort of retracement, maybe into sell side liquidity, market maker sell model on the lower time frame. And then from here, if you get SMT on the lows, for example, then you could look for continued higher prices. In this case, I'm not sure what Nifty 50 correlates to, so I would just say look for some sort of liquidity sweep. And then after you get some structure forming, let's say you get a number of market structure shift right here, just keeping it simple again, market structure shift right here, then this would be a good area to look for continued higher prices. But the only reason why I'm short-term bearish on Nifty 50 looking at this chart is because previous year high just got purged, so I can see a retracement. So key areas to pay attention to would be this sell side liquidity here and this fair value gap right here. So if this fair value gap is disrespected, let's say it closes below, then you are most likely going to go for these sell side liquidity. If this is respected and you have like a wick through right here on this candle, then I just look for how does this candle close above this previous year high, and you can potentially look for continued prices higher. So those are the two ideas I would have for this. But overall, I am still bullish on this chart. looking at it.
Okay. Stu says, since we're not seeing wait, do we? No, we didn't. Since we're not seeing strong reactions at ERL and ES and YM, PA looks likely to go to 11, 12 highs before forming bearish SMT question mark. So before, like, even if we answer this, I do want to say, like, look at the language you're using. This is almost like a feeler. We want to react to the market and not try to predict the market, though it does kind of look like that. We just wait for like SMTs to form and we follow the same plan. Like Ethan's, if you go back to our a little bit earlier in the Q&A, we talked about like what we're kind of looking for, the higher time frame, taking IRL into ERL. Like we try to just keep it as that, SMTs to confirm, and we don't want to like, oh, it just looks like what's stronger, what's weaker, what's going a bit higher, what's going a bit lower. Because when we start trying to predict the market, we build cognitive biases, we build things that kind of blind us from what's actually happening, right? Trade the charts, not your heart.
Yeah.
So
I would say like, okay, so here's the thing about I think your question is coming from a place of discretion. So the problem, like the reason why I have the trading plan I have to this day is because I didn't find too much favor when I'm being discretionary. I used to be like pretty much fully discretionary in my trading, and like just very similar to Elijah's, like just higher highs and lower lows in our journey. I rather just settle for a framework, work around that framework. So now it's more like 80% objectivity, 20% discretion, rather than 50% discretion, 50% objectivity. The more objectivity you have, I feel like it gives you a better barometer long term as to what you need to actually implement in your trading, because that data is consistent. If I'm taking a trade because, oh, this order block looks bullish today, but tomorrow that order block, let's say it looks bearish, or this fair value gap, there's a lot of inconsistencies. The more complexity you add, the more inconsistencies you're going to see in your data. So just try to keep it as simple as possible. Narrow your framework down to one or two concepts that resonate with you. And for us, that would be like market structure, internal, external, and also SMTs, right? So that is our framework, just narrowed down to three things that we mainly use to build narrative, to look for entries. But again, it's just really honing down. And when you reflect upon that question, is like, to be honest, you should have an answer for that question yourself, because your trading plan should be the answer, right?
I think she's restructuring her question to what gives confidence for ERL to IRL. Do we need it to come back into the range immediately? I think that's what.
Oh, okay. Yeah. So to answer that question, again, it's something that's going to be in your plan. But for our plan, what tells us that is SMT on an intermediate term time frame tells us that we're going to be looking for external to internal or internal to external. And then the other side of it is, if people don't use SMT, we always suggest just using market structure is also a really great way to navigate the market. It's just top-down analysis, right? So daily, let's say you're bullish, just like right now, for example. Okay, if I were to do singular chart analysis on Nasdaq right now, we took out external range liquidity. What would make me bearish right now? What would make me bearish right now is I'm looking at this as my intermediate term time frame range, right? So this low is the protected low. Until price closes below this low right here, that would change the trend on the intermediate term time frame, aligning me with the idea of external to internal range liquidity. And so I would then draw my dealing range, lining up the intermediate term time frame, and then repeat the same thing. Let's say the intermediate term time frame has a fair value gap right here. Then I just drop down to a lower time frame and I simply wait until price trades into it. Again, if you're not using SMT, you just wait for another market structure shift to go lower, right? Let's say you have a market structure shift right here from the intermediate term time frame key level. And then that can just, a very simple way to just enter the market like that, right?
Yeah. But does it need to come back into the range immediately? it comes back when it tells us to. That's pretty much the answer.
Yeah, the answer is
We react to
whatever
it.
your confirmation is, that is what's going to tell you.
It could be immediately. It could just not give us the intermediate time frame, time-based S&T. Then we just don't have a trade, right? Then we just see if it makes a new range, see what kind, basically go according to what price gives us. How many trades do you usually take per week or per day? Do you have any rules for that? And what are you risking based on setup or fixed risk? I can answer that.
Yeah, you got it.
So per week right now, like this past month, we've been looking at maybe max 3 trades, maybe.
Yeah, 3-4 trades.
Yeah, 3 trade ideas. Like we have had a week where we just had 1 trade idea pretty much. It's just a slower month this month, but generally it does actually float around that 3-4 max a week. And we give ourselves 2 bullets a day. We have a fixed risk according to our drawdown. So I think all of our accounts we trade 2K drawdown, 50K prop firms. So that means, and we like to, according to the statistics and what works best with our model and also our psychology, which is very key, is risking about $200 per trade. So we have about 10 trades in a row that we can lose straight until we lose our account, right? So that's how we risk it. 1 R to us is $200. We get 2 bullets a day. We rarely, I won't say rarely, but we don't often use 2 bullets a day.
Yeah, very.
So
Pretty rarely that we use 2 bullets a day. It's usually the first trade is either a win or a loss, and then the second trade we just don't have a second opportunity. But yeah, that's kind of the way we trade is like that because we're intraday trading, right? We're trying to catch the daily range. If you want to use our model on a scalping time frame, so you're trying to catch the 4-hour candle, the 1-hour candle, that works fine as well. You just have to apply our model to 1 time frame lower. So we use daily time frame as the higher time frame, and then the 6-hour or 90 minute as the intermediate time frame, and then the 15 or 5 as the lower time frames. But if you want to apply that to a scalping time frame, you would do 6 hours your higher time frame, 90 minute or 15 minute as your intermediate term time frame, 5 minute or 1 minute as your lower time frame. So it's just shifting. Time and price is fractal, so you are welcome to do that. I used to trade that way. I just moved up because it's easier to announce my analysis and stuff like that whenever I'm in a trade. Easier to manage it, right? I used to trade on the 15-second chart, but
yeah, it's better emotional stability as well.
Yeah,
but it really depends on the person. That truly does depend on the person. What are the correlated assets for gold? Sue asks. I know silver, but I don't know what else.
Have you guys found a way to tell which fair value gap will retrace back to without intermediate term confirmation? To be honest, you could use volume profile. I don't do it, but it's definitely something I've been back testing. But volume profile, if you have, let's say, single prints or you have low volume areas, then you can use that to refine within the market structure where you're looking for retracement. And then by looking at volume profile, you're actually looking at the inefficiencies of the market, right? So that's a very good way to gauge where is a good retracement spot. But for the most part, regardless of using volume profile or not in my model, I still need that SMT there. So as long as the SMT is there, that's what I'm looking for, really.
We try to keep it as simple as possible, guys. Model up, model down, model up, model down.
Yeah.
Nothing more to it.
I think the most important thing is keeping your trading as simple as possible without restricting yourself. So what does it mean, like simple? Like simple is having a broader framework to work around that is adaptable to all situations. Because I think a lot of times when people say when people think simple strategy, they start thinking like, oh, I'm going to, this has to happen, this has to happen, this has to happen. And everything has to align, the stars have to align for me to take a trade. That is not simple. That's actually quite complex. And it's something that won't show up very often when you put it that way. So you need to give yourself room to work with within your framework to build a logic around the market, because patterns will always have some sort of diminishing return. You need some sort of narrative building tool. What is the news today? What is the price action telling me in terms of market structure, for example? What is the specific price patterns telling me, right? Technical analysis, in my opinion, is just simply a way for us to visualize what the market is trying to do, but it's just there to complement our fundamental analysis, if that makes sense. So if Trump is extremely bullish and he's the president, he's telling everyone to buy, most likely your sentiment's going to be buy, right? So I just use technical analysis in alignment of that fundamental analysis to find higher probability trades, if that makes sense.
Makes sense. I'm trying to find a balance between catching counter trend news and not overdoing it. Or sorry, that makes sense. I'm trying to find a balance between counter trade move and not overdoing it. Okay. Yeah, the moment you start looking for too much, it's just it really messes with your head.
Yeah, just don't look for too much. Just ask yourself, what's the news today or overall? Mm-hmm. Step number 1. Step number 2, does price action support my thesis on the sentiment of the market right now? And then from there is like 3, just look for your model within your framework.
Oh, question directed to me. Hi Elijah, you mentioned previously you had early success and went on a dry spell. When looking back, would you have done anything differently? I would not have done anything differently. Honestly, I actually, like, looking back now, it was actually a blessing. So you know the saying, fail fast, and I got to experience a different level of failing that many people don't even get to experience in maybe 5 to 10 years of trading, right? Mm-hmm. It was insanely high highs. Like, I won't get into details, but it's like within an 8-day trading period, like, you know, you pass your counts and like it was like a 5-figure payout, and it was like crazy. It was like, I've never seen this kind of money in my hands. Obviously I didn't spend it wisely, you know, a little bit younger, early in my trading, you know, it's just
yeah, that's how it goes, man.
Sometimes it's how it goes, especially with your first payout. You're like, oh, these are gonna keep coming in real quick, you know. And it taught me a lot looking back, and it still does. Like, I constantly reflect back to that moment, because I don't want that to happen again. I'd rather not have that kind of like big high, really high highs and a dry spell or lower lows. I'd rather have consistent. I wouldn't mind even taking like 1/4 of that payout, but consistently, right? Mm-hmm. Rather than just a big high, low, low, right? So I'd rather have that, better stats, more consistency, emotionally happy, not like pulling my hair.
Emotionally stable.
Yeah, like honestly, like if I was to like explain it even more, like during that time, sometimes like when trades work against me or like the leverage I was putting in, I was literally sweating. I was like sweating while I was trading. And
I never got there, but
that is you don't want to get to that point. Let me tell you, you don't want to get to that point. Like, yes, you hit like 13 R trades, but like you lose 3 years on your life. You know, but yeah, I would not have done anything differently. But everyone has a really unique journey. Even if you get the ability to slowly build it up and not have this high and low, that's also an extreme blessing, right? It's just like however you look at it, right? You want to learn from it and don't waste it, right? If you don't learn from it, then it's not experience. It's just a waste, right? It's just trauma or just a memory, right? Turn it into something good.
I think something really important is like, I know, okay, so until you actually experience it for yourself, like people will say keep things simple, for example, or they'll say trust, like submit to time, right? Like what does that actually mean? Like when you're putting it to actual application, or they'll even say, let's say, trust the process, fall in love with the process. Like what would you say that looks like or that felt like for you?
Sorry, repeat that real quick.
I was saying,
I just
like,
TLDR.
what would you say trusting in the process actually looks like, and falling in love with the process looks like? Or I guess for you, like, what did that experience, like, what shifted your focus from outcome to process, and how did that actually feel, and what does that actually look like in everyday life?
Okay, so I'll just start with like, how did it feel first? Is that the yeah? I'll start with that. Honestly, I had to go through a lot of hair pulling, praying, like literally crying, I'm just like, I feel like sometimes I could be like an emotional guy, but it's just like, you just go through everything. You go through everything, and you gotta really just take it in, and you just get tired of it at some point. And the feeling is honestly like hopelessness, but not to a point where like you just dig yourself a deeper hole. It's a hopelessness to a point where you're sick of it and you want to do something about it, right? And then you do something about it, and it's like, what do? You know, everyone, I feel like deep down, and if you look at generally good traders, right, they'll tell you all the same thing, right? And you guys know what will give you success, right? People keep repeating the same thing, right? You know, don't over leverage. Why are you taking like 30? Oh, it depends on your style. If you're a scalper, that's different. But you know, in general, why are you taking like 30 plus trades in a day, right? Why are you adding to your losers? Why are you not following your risk plan? You said you were gonna be okay with losing $200 today, right? Why are you? I
wasn't really okay with it.
Yeah, like you're not, and then you reflect back, right? If you're not actually okay with losing 200, then maybe you have to shift that up, or like shift that down. Sorry, but like, you know, if you psychologically can't take that, then you might have to do 150, right? But there is a certain limit to that. I would recommend like at least 150 or higher, especially on a 50K account, because it's just hard to size. But you have to get comfortable with that, right? And if you can't, then you have to adjust something to be comfortable with that, right? It's not just your technical analysis. It's not just how much drawdown you have. It's how much mental, mental capacity you have, right? To be able to take it on, right? And that's probably a big thing. And then like what it kind of looks like day to day, honestly, and I know everyone says it, but you don't really realize how boring it is. It gets so freaking boring, but you just wait and you trust the process, right? But like back then I'd be like, oh, like it's so boring because I'm just like following my risk plan, and I'm actually just like, I'm still just risking like $20 a trade, but I'm making up confluences to take a trade. I'm still like hunting for something, you know? Like true boredom is just, you just have like
this,
you hop on, you have like 4 things you look for, it aligns, you take it. It doesn't align, you just sit there like, it's like this, there's like nothing, right? And sometimes the market can give it to you really quick. Sometimes it can take a long time to develop. But like at the end of the day, like there's so many days we just don't trade. And that, well, according to our model, right? There's just so many days we don't trade. And that's what boredom really feels like. Boredom is literally staring at a screen and just not doing anything, and being able to do that and being okay with that. And knowing that even if you're not doing anything, and even if you do something with all 4 things or like 3 things or whatever you do for your model aligned, and you take a red day, that you're still progressing, right? So you have to like just really accept that. And if you don't accept that, that's okay, but you're just not going to be sustainable long term, right? And that's just how it is. It's just the truth, right? And especially the way that we trade, catching the daily expansion. Scalping, I know it's different. It's probably a different mindset as well. Same with swing trading, because personally, like, if, for example, here's an example. Like, if I were to swing trade, I feel like I'd find it hard to not check the charts.
Yeah, you'd be checking it.
Yeah, I'd be checking it a lot, right? So it's like, to each their own. But if you're trying to catch the daily expansion or follow a similar model to us, then that is what it will feel like. That is what it will be like. That is what it is, right? So that is what it feels like. Thanks,
That's great.
Andre and Ethan. Appreciate the feedback.
Thanks for sharing, man.
Yeah, no problem.
Yeah, I mean, wow, we've already been here for an hour. That's crazy. That felt like 20 minutes.
Yeah, actually. Wow. We're like, oh, not too many questions today, and then we just like ramble.
Yeah, we just ramble.
All right.
But yeah, I want to say, like, trusting process, like, it really just comes to a point where, like, it's just a breaking point where you're like, I'm sick and tired of this. Like, it's the moment where you feel like I can't do this anymore, but you decide to persist through that specific moment, and you're like, I need to change something. And that's when you're actually willing to take a look at your overall trading journey Because if you were to look on your whole trading journey right now, like, would you say that you actually take it serious? Are you actually journaling every day? Are you actually backtesting? When you're trading, are you actually following your risk rules? Are you actually taking the setups you said you're supposed to take? Are you actually following your pre-market plans? Right? All of that stuff. Are you taking this business seriously, or are you just here because you feel like it's easy to click a button and make money?
And another thing to add on that is, since you are the business, are you taking care of yourself?
Yeah, that's
right?
a really big
Are you waking up on time? Are you getting enough rest? Are you eating well enough? Are you starving at like 2 a.m. in the middle of your room just clicking buttons? Yeah, that's like 99% of chance that it's gonna be a formula for a bad time. So
yeah, so it's like like a lot of people say, like, take a hard look in the mirror and ask yourself, like, are you taking this seriously? And a lot of people don't even realize that what they're doing is majority of the time is gambling. It's like you have to really reflect, and if you can't see your own blind spots, it's really important to have people around you that can see the blind spots for you and point it out and call it out and hold you accountable, not just affirm your, I'm gonna say it, affirm your delusions, essentially.
yeah.
Like, you can't go into every, like, CPI, I'm gonna full port this and make $1 billion. Like, that's a delusion. And I know there is traders that do that, right? But if you were taking trading seriously, you would know CPI is something I shouldn't be trading, unless, let's say, you're doing like long-term trading, then it's fine. But it's just something you shouldn't be trading. Let the news event pass and then trade, right? It's so simple. Like, these rules are so simple. I know I shouldn't be taking more than 2 trades today, but I took 5. Am I taking the business seriously? Right? I know I shouldn't be risking more than $200, but I do it anyways. Am I taking the business seriously? Right?
Always go strictly for IRL or ERL. Pretty much.
Wait, sorry. What was the question? So you always go strictly for IRL, ERL? Yes, that is my model. Higher time frame, ERL, IRL as the narrative, essentially. Well, I guess the narrative is fundamental analysis, is like what is happening in the world right now. But 2 is just the higher time frame picture, big picture of things. Higher time frame, IRL, ERL. Immediate picture of things is intermediate term time frame, IRL, ERL, and then execution and management is just lower time frame.
That's a good question. Hi, Ethan and Elijah. Were you guys always intraday traders versus scalpers, or just adjusted based on your personality? I feel like we were all of them.
Yeah, we were all
Ethan's done swing trading. Ethan's done 15-second scalping. I've done like a lot of 1-minute work. I've never swing traded, but I did intraday and scalping as well, and 1-minute trading. And we just, like, they were like, you can make money for sure, but it's just for the way Ethan and I trade, we noticed that we crashed out a lot. It was very inconsistent. The data was not great. Yeah, the biggest thing was emotional stability. So that is when we realized we need to step back and slow it down. And what's the best way to step back and slow it down? Since time is fractal, we just shift everything up a time frame, right?
So I would say it's like we've done it all. We've made money doing it all. But it's about what is the most consistent. So like scalping, we made money doing it. In fact, we made a lot of money doing it. But it's kind of that cycle. It's like, are we actually being a professional trader right now, or are we just kind of playing the game of props, right? So if we want to become sustainable professional traders, we can't be losing the emotional stability. For example, like we'll make a ton on prop firms, and then like maybe we have one bad day and we end up over trading and we blow the prop firm accounts, and we're like, oh, it's okay because the risk to reward is so great. Like I got a payout. I already paid off all my accounts and more, and I can just get new accounts. Who cares, right? That's playing the game of props, which I don't have anything against. You're making money, right? At the end of the day, you're making money. But if we want to translate our skill into personal accounts, start compounding our profits, then we have to start learning how to trade sustainably, right? And so that's why I started dabbling with like swing trading and intraday trading. I found intraday trading to be like the sweet spot because it's like I enter on intraday trade and I also get to hold it for swing targets. So that's the way I like to trade. Again, I could incorporate the scalper's time frame, but it's just, again, it's too much emotional toll on me because I have to, 1, I have to teach it. 2, I have to announce it. 3, live streaming it is not fun either. And then It's just like when you have so many things to focus on in the session, it's a lot easier for me to derail myself. Emotional stability, it's a lot easier to derail when I have so many different things to focus on during my training session. So if I stop teaching and stuff like that, then I would be okay with going back to the scalping timeframes. I would.
Yeah, it's like when you announce it, it's already 4 candles gone away.
Yeah, it's like, how much mental capital do you have? Like, that's the question, right? It's like, because I had a student before, I'm not gonna name them by name, but they asked me, it's like, why don't you trade the 15-second chart anymore? I missed the 15-second chart when you were teaching and stuff like that. And I was saying, and they were telling me, it's like, it's like, it feels bad after I get stopped out after like 5 minutes or maybe 15 minutes. But my question to them would be then, what happens if you enter and you stopped out in 15 seconds? How would that make you feel? Right? And on top of that, your risk management plan tells you you're allowed to take a second trade. So how do these things add up, right? Your mental capital is already a lot weaker or a lot more drained after that first loss. You entered, immediately lost, let's say $200 times 15 accounts. How do you feel, right? So it's really important to gauge. And this is what I'm talking about when it was the psychological edge before in the previous Q&A when I talked about it. Psychological edges, understanding yourself, your mental capability, and what qualities you have that you can use to your advantage, right? Some people are better at discipline. So it's like, once I'm in, I'm out, I'm done for the day. Maybe some people are better at that. Some people are better at patient. I'm in, I wait for my trade, and then it closes. And then by the time their trade is closed, it's like end of day. They're like, okay, there's no point in trading, right? So it's like using these different qualities to leverage your edge, psychological edge, to complement the rest of your technical edge, your fundamental edge, right?
Okay. Mikey Mike asks, you only trade 9:30 until 12? Yes. Most of the time, yes. We trade around volatility injections. Yeah. So we, most of the time, like almost never trade PM. The only time is that it's valid to trade PM is when there's a volatility injection within PM. So that would be like FOMC and FOMC meeting minutes, right? And then sometimes there's 8:30 news, so then we can look for something maybe at around 8:45 or anytime after that. So we basically just work around volatility injection, but that does end up being mostly 9:30, between 9:30 and 12. So yeah.
Yeah.
Okay.
All right, I think we are going to wrap up here. If you guys have any final questions, feel free to type them now and we'll like answer them before we head out here. But if not, then happy holidays, everyone.
Yeah, happy holidays. Exciting stuff. Hopefully you guys can find some good deals. We have not found any.
Yeah, we have found no deals. We were just talking about it like yesterday. We're like, the Black Friday deals, like back then they were like so good. Like 70% off everything in store, buy one get 10 free. But now it's like, we were walking around, it's like 10% off today. It's like 5% off. Like, goodness.
So I'm later this year. Peace.
Take care.
No problem.
How many in here are from the GTA? Maybe we do in-person meet down the road at a Starbucks. No, I think if I were to do a meet, like what I want to do is like book out like an entire convention center. Just have people, like fly people out, that's like my students out and stuff. Yeah, that's a dream. So I think it's definitely doable. Just gotta find a day for that.
My question is that which model I should stick to it, please.
So the model you should stick to is ours. No, I'm kidding. No. But I would say whatever concept resonates with you. So like right now, the fact that you're asking that question, it tells me that you don't have a model. And so you need to start building a model. Everyone's different, right? You can copy someone's model, but that means inherently you have to learn the skills, the psychological skills that they have as well. If you were to build your own model, then I guess it's like there's like pros and cons to both. If you copy someone's technical edge, that means you have to build your psychological edge. If you identify your psychological edge, then that means you can build your model around your psychological edge. So it's just whichever side you want to battle. I think taking someone's model is usually the way to go because it's already statistically proven, and working on yourself is a lot easier than trying to figure out if your model is profitable or not, because the market's pretty dynamic. But I would say find what resonates with you. So when you're first starting trading, I know a lot of people say don't strategy hop, but I say strategy hop, let's say 5 to 10 times, and then figure out within that like 5 to 10 strategies you tried, which one resonates best with you, which one made most sense to you, and then stick to that model forever. Never change it ever again, because you found some sort of resonance with it.
Yeah, you can make refinements, but don't do it quickly. Do it based off of data and actually like long-term data. Like I would say like maybe even like at least half a year data, especially if it's already profitable and you don't really need to refine it. I was about to just say pretty much the same thing, right? It's okay to take a model from a mentor. I think it's not a bad idea, especially it's a good starting point, because a lot of people is like, where do I even start in making my own model? Like what the heck?
Yeah.
But like I take stuff from Ethan, I take stuff from like other people, like Guy and stuff, and you just kind of really see your style, right? And not only looking at the model, but look at the mentor, right?
Yeah, that's a big part.
Yeah, look at the mentor. Are they calm? Are they collected? Like Jesse, for example, or Casper SMC really resonated with Ethan, right? It's really simplified Ethan's trading, really calm, really chill, and it's like that's kind of the way he goes. Some people like people that are like excited scalpers, but then they also still have their limits, right, on their day. Like they'll still stop when they know they need to stop, right? But they're just like faster pace, like almost like ADHD brain kind of thing. But it's like to each their own, and that's something to really look at, not only at the model, but look at the person you're learning the model from, because they found success in it, but like what are they like? How did they find success in it, right? You might not find success in it too, right?
So that's a very big point. Actually, choosing your mentors is just as important as choosing your model, if not more important. But some tips to build your own model is, I would say, similarly to strategy hopping, do concept hopping, right? Maybe try like 5 to 10 different concepts, see which one resonates best with you, stick with that one concept, and then in the future, if there's more concepts that resonate with you, start like applying like maybe maximum 3 concepts to your model, okay? It shouldn't be more than that, in my opinion at least. And then just stick to it, keep it simple. And then in the future, like I would say at least 20 trades worth of data, you can look at that entire span of data and be like, okay, what's the common recurring thing that's holding me back, and refine it. But only refine one thing at a time, I would say. Otherwise, you're just completely changing the model, right? Too many variables are changing at the same time. Change one variable at a time.
You guys.
But I would say for selecting a mentor, track record is quite important. It would be ideal. I know a lot of people don't provide track records, but if they don't provide track record, at least make sure that they trade live with you, right? So it's either track record or live trading with you. That's very important, so you can actually see the transparency behind what they're teaching you. Because what some mentors do is they teach you everything, and then they don't trade live in front of you. After the fact, they'll point out, this is why this trade worked, and this is why your trade didn't work. And then they'll use all of those different, like out of 100 concepts, they'll use maybe 3 of those concepts to justify why your trade was wrong versus their trade was right. But you never saw them trade it, right? Mm-hmm. So that's a very big red flag if they're teaching you 100 different things. And also, if they don't trade live in front of you, either trade live in front of you or track record, right? Mm-hmm.
It just says, thanks for brothers. What do you think about learning Unicorn? I think Unicorn's great. Unicorn's a great place to start off.
Yeah, Unicorn's a great model, I will say. And
I think we have a video on our YouTube.
Yeah, I have a video on it.
Yeah.
So I would say Unicorn model, if you were to simplify it to its core, the market structure model I showed you earlier in this Q&A, keeping it simple, if you have market structure shift, that's a Unicorn model. Like 98% of the time when you have a market structure shift, you have a Unicorn model there. So keep that in mind. Keep it simple, right?
He's been summoned. Golden Nugget has been summoned.
Yeah. But yeah, I think that would be my advice on models. And yeah, just make sure that you have a solid trading plan. Like, so many people don't have a trading plan. They're just like, when you ask them what their trading plan or strategy is, they literally like try to make something up on the spot. Yeah. But like, what does that actually come down to? You know what I'm saying?
Yeah. Okay. We should cut it off here.
Yeah.
If we don't have any more questions. Thank you guys for tuning in. Happy Friday. Have a great heckin' weekend. And we'll see you guys on the charts Monday, I guess.
Monday or Tuesday.
Yeah, Monday or Tuesday.
Yeah.
You can catch us in a Discord, link in bio.
Join for free.
But we're always out there. But we'll do Q&As once in a while again. It just depends on what you guys want. If you guys don't need it, don't want it, don't like to see it, hurts our feelings a little bit, but it is what it is. So we'll go about that. So yeah, take care, guys.